very fast. Good morning, ladies and gentlemen. It is indeed my pleasure to be here this morning, and in fact, it's my honor to present to you my colleagues and friends. My presentation today is on overhead cost audits and overhead rate preparation. But before I begin, I always like to start with polling the audience. That just helps me to frame the presentation and tailor it to hopefully, meet all of our needs. So, if you would please, by show of hands, let me know who the auditors in the room are, whether you work for a CPA firm or whether you work for a governmental agency. Holy smokes, I definitely have a lot of support here today. How about controllers, CFOs, company management? Okay, super. You. And then how about the governmental officials in the room, whether you're a procurement officer, contracting officer, or otherwise a governmental official? Oh, fantastic. Okay, super. We've got a pretty good, diverse set of people here today. One last question. Of the auditors in the room, how many of us have assisted our client or our auditee with the preparation of their overhead rate schedule? Now, I know I have. Okay, so a number of us have. And, later on in the presentation, I have a slide that deals with independence whenever you perform a non-audit service or non-audit involvement for those auditors that work for the government. So we'll get into that a little bit later on. The learning objectives today, there are 3 of them on the screen. But, fundamentally, what I really hope we get on in today's session is just a renewed appreciation for the different challenges that we all have, whether we're an auditor working for a CPA firm, whether we're an auditor working for a state Department of Transportation, or whether we are a governmental official responsible for the fiduciary oversight of programs and dollars. And we all have different perspectives. And I think the unfortunate thing a little bit is that since most of us here, in fact, John Bogart told the audience earlier, I think just about all of us, with the exception of one person, is somehow an accountant or an accountant type or auditor type. And I think the unfortunate thing is that sometimes people kind of assume that we all have the exact same perspective. We're all quote-unquote auditors. And while there's an element of truth to that, I think the reality is we definitely have different perspectives and frankly different needs. So hopefully we'll get into that as well. And then at the end we'll look at some common findings and things like that. The agenda today, I'm going to spend a considerable amount of time going over the technical stuff, the conceptual framework, if you will. Accounting and allowability standards. And accounting, I'm using it generically, meaning the standards that are applicable when preparing a FAR-compliant overhead rate schedule. The auditing standards, the standards applicable to auditors, whether you're a CPA firm auditor or whether you're a governmental auditor, the standards that are applicable to us. We'll look at the fundamentals of an overhead rate audit, kind of from beginning to end. We'll look at some common issues and findings, and then we'll kind of wrap up with some Q&A. So I've got about 10, 25, and 6, something like that. I'm going to go about an hour and 5, maybe 10 minutes. So that'll give us plenty of time, get 15, maybe 20 minutes for Q&A at the end. Now the next section after this one is lunch. So I definitely do not want us to be late for that one, so I promise we'll be ready to go to lunch in plenty of time. One last thing that I need to mention. So, this is a technical topic, and, technical is sometimes code for potentially boring. And ladies and gentlemen, I am definitely not a comedian. I'm not very funny. But I do like to have a little bit of fun. So what I've done is I've inserted polling questions throughout this presentation. So I have 2 requests for everybody today. 2 requests. First, I hope that everybody takes at least one thing out of this presentation that you can take home with you. And the second request is to please participate in the polling questions. Designed to make it more interactive, designed to make the time go by a little bit quicker, okay? So let's try to have a little bit of fun here. We're all amongst colleagues and friends, so let's see if we can't make a boring topic maybe a little bit fun. So with that said, the first polling question is a fun one. So we all flew into Phoenix. So Phoenix was originally known as A, Stonewall, B, Pumpkinville, C, Hohokam, D, Salina. So by show of hands, how many think A, Stonewall? It's the original name of Phoenix. How about B, Pumpkinville? C, Hohokam. And then finally D, Salina. Couple. And the answer is Pumpkinville. And it was known as Pumpkinville because of the pumpkins that flourished along the canals. Then later on, a gentleman by the name of Lord Darrell Dupa suggested the name Phoenix. Described a city born from the ruins of a former civilization. Of course, that civilization being the Hohokam Native Americans. And Phoenix is, the rising of the ashes and all the other good stuff. So with that said, the rising of the ashes, let's look at the authoritative guidance that has risen from the ashes over the years. Starting with accounting and allowability, we're going to spend a lot of time with that, and we're going to spend a lot of time auditing. So think of it in terms of two worlds, if you will. Okay? Another polling question. Thinking about the authoritative guidance, the accounting, if you will, which of the following do you believe is considered authoritative for private or profit contractors when preparing their overhead rate schedule? So we have A, IRS tax rules, B, government accounting standards, C, federal travel regulations, or D, federal acquisition regulations. So of the four, how many think A? How about B? How about C? How about D? All right, I'm going. Authoritative guidance. Federal acquisition regulations is definitely one of them. But in addition, we have generally accepted accounting principles, also known as GAAP, and the cost accounting standards, also known as CAS. Now, for the auditors in the room, which a lot of them, what's considered authoritative guidance here? We've got A, the DCAA, which is the Defense Contract Audit Agency, their audit manual. We've got B, the ASCE, that's the American Society of Civil Engineers. There's an engineer somewhere that covers that. Their audit manual. The government auditing standards, or the international standards on auditing. So how many think A is authoritative for auditing? A few of us. How about B? How about C? Okay, too smart. How about D? International rules. So in the area of auditing, there are three fundamental areas. You've got the AICPA, Generally Accepted Auditing Standards. You have the Generally Accepted Government Auditing Standards, also known as GAGAS, or the Yellow Book. And today I'm going to refer to it as GAGAS. I think that's what most of us are used to, or certainly I am. And then finally, the AICPA attestation standards. So we'll look at each one of them in more detail. A word about the AASHTO Audit and Accounting Guide. Although it's not technically authoritative, it is a wonderful, wonderful tool in that it consolidates and it brings together a lot of the, in fact, most all of the authoritative guidance that's out there in the FAR, the CAS, Generally Accepted Accounting Principles. So that's in the area of preparing the overhead rate schedule. And it brings together some of the relevant auditing standards, both from the AICPA standpoint and from the GAGAS, which is the GAO, Government Accountability Office standpoint. So it's a wonderful, wonderful tool, and I encourage all of us as auditors and all of us as the management of contractors to utilize the AASHTO Audit and Accounting Guide as a great tool. So now let's talk about the very first authoritative body that's out there, and that's GAAP and codification. So a quick polling question. Have you heard of the accounting standards codification? Does that ring a bell? Maybe by a quick show of hands. Okay, so most of us, some yes, some no. The codification, what it is the FASB back in 2009 codified GAAP. In other words, prior to that, GAAP was frankly all over the place. You would have the FASB original pronouncements, you would have EITFs, you'd have FASB technical bulletins, APB opinions, and so forth. And in addition, there was a concept known as the House of GAAP, meaning that some GAAP is more authoritative than other GAAP. Very confusing, very difficult to research issues, and so forth. So because of that, and but this is truly the reason why, because of the push in our country to converge standards, our U.S. generally accepted accounting principles, with international financial reporting standards. The first step was to codify GAAP so that it's more consistent with international financial reporting standards. So as you can imagine, this is like a 144 million page codification thing. So it really did bring everything together. There's 90 topics. It did not change GAAP, however. That's important to note. But simply put, if it's not in the codification, it's not GAAP. And so it's relevant GAAP for your non-governmental entities, which is what we're talking about here today. The structure of the codification is structured by topics, subtopics, sections, and subsections. The topics are the broadest category. So for example, if you have an issue, you're interested in liabilities, that is codified in topic 405. If you're interested in the extinguishment of liabilities, the accounting for that, well, that's in topic 405, subtopic 20, and so forth. The sections are underneath the subtopics and normally deal with stuff like recognition, measurement, disclosure, things of that nature. And then finally you have subsections. There's not very many subsections, frankly, in the codification. By way of a quick example, so FASB statement number 5, which most auditors here are familiar with, that's the FASB statement on contingencies. That has been primarily codified as Accounting Standards Codification Topic 450. FAS 13, which is frankly very relevant many times when preparing or auditing an overhead rate schedule, because that is the gap that controls whether or not a lease is a capital lease versus an operating lease. And depending upon that classification would likely have a significant impact on the overhead rate schedule. So that gap has now been primarily codified in Accounting Standards Codification Topic 840 and so forth. Now, noteworthy item, there is a proposal to amend FAR to update references from the I'll call the old GAAP references to the codification. So just by way of letting you know that that's out there, awareness. Now let's talk a little bit about the FAR. What is the FAR? And what's the purpose of the FAR? What does the FAR stand for? Let's start with that. Thank you. And anybody, what's the fundamental purpose of the FAR?
To give you guidance on allowable.
So I hear guidance on maybe procurement? For commercial, thank you, for commercial organizations. So the Federal Acquisition Regulations has beginnings in the Armed Services Procurement Regulations, established back in 1947, so after World War II. The FAR was codified in Title 48 of the Code of Federal Regulations in 1984. Now, the fundamental purpose is for the government, the federal government, to establish procedures that are standard and consistent. And so that governmental procurement purchasing is done in a fair and impartial manner. So the idea is that if you're a contractor, if you're a consultant, and you want to do business with Department of Energy, Department of Defense, Department of Transportation, Federal Acquisition Regulations are designed so that procurement occurs in a standard, consistent, fair manner, regardless of your political affiliations, regardless of any of that stuff. So that's the fundamental objective. There's another bullet for us to ponder. What 3 elements must it cost to be recoverable? Okay. Applicability. And then, of course, the third one, which is always the interesting one, is the $900 toilet seat, the 2-story suite in Vegas, right? Okay. Oh, we said that. Reasonableness. So yes, so you guys are too good. So to be recoverable, the cost must be allowable for Part 31 and the contract. Okay. Allocable, must be allocable to the contract and has to be reasonable. So the government can recover costs that do not meet these three fundamental requirements. Okay. Our Part 30.205 contains about 50 selected cost items, give or take. Some are expressly allowable, some are expressly unallowable. The unallawables, I think we've all seen this, you've got alcoholic beverages, fines and penalties, entertainment, things of that nature, nothing new there. Another polling question for you. True or false? False. Give you my mic. That's correct. The answer is false. The FAR is not going to address everything, okay? So if it's not the FAR, it doesn't mean that it's allowable. It doesn't mean that it's allowable. Rather, allowability is analogously based. And ladies and gentlemen, I know that there is a significant element of judgment here sometimes. I know that the world, unfortunately, is not black and white. There's a lot of gray. And sometimes, as auditors, and sometimes as management, charged with preparing these rates, it's tough to interpret correctly when you have a certain fact pattern about the allowability of the cost. And unfortunately, I don't have any huge pearls of wisdom or anything like that, other than to say that occasionally what we will do when we're challenged with an area that's very gray is we'll take a look to see if there's anything out there by way of a court case or the Armed Services Board of Contract Appeals sometimes will have something. And again, the idea there is just simply to shed some light to see if there isn't an analogy out there to help us ferret out a set of facts and circumstances that we're trying to interpret, particularly us as auditors, that we're supposed to be fair, impartial, and independent. Polling question. How about the CAS? What's the CAS? You guys are warming up. I like it. So the Cost Accounting Standards Board, established as an agency of Congress actually back in 1970, dissolved in 1980, reinstated in 1988, couldn't make up their mind. It's authorized to develop cost accounting standards. The CASB has issued 19 cost accounting standards, all of which have the full effect of law. The fundamental objective of the CAS is, of course, uniformity and consistency in cost accounting. Okay? It's concerned with three basic areas of cost accounting: the measurement of costs, the assignment of costs to a cost accounting period, and then number three is the one that seems to be the most challenging, and that's the allocation of cost to cost objectives, meaning contracts, programs, things like that. So number three is the one that seems to be the challenging one. There they are, the 19. Now we're going to go through each and every one. But we do have a polling question, true or false? All contractors must follow all 19 cost accounting standards. False. You guys are too, I can't stump you guys. The answer, of course, is false. CAS coverage is dependent upon, this is generalized, it's a little more detailed than this, but in general, okay? It depends upon the funding level. So there's a concept of full CAS coverage, modified CAS coverage, and then of course exempt. In general, full CAS coverage, that's $50 million in an individual federal award. Modified, so under full CAS coverage, all 19 would apply to, okay, to your organization. Modified CAS, in general, that's $7.5 million federal award. And there, if you're modified CAS covered, then you need to comply with 4 cost accounting standards: 401, 402, 405, 406. And then finally, exempt. Normally, you're exempt if you're considered a small business as defined by the FAR, or obviously if you have, awards that are below the thresholds, okay? The CAS, the cost accounting standards, and the FAR are not one and the same. The CAS addresses cost accounting. The FAR addresses allowability. The FAR is really more of a procurement item. while the CAS is truly more of a cost accounting item. And you know, can an allowable cost be allocable? And the answer, of course, is yes, of course. And again, what's the difference in liability versus cost accounting and allocability? Okay. So now we've covered very quickly the fundamental conceptual framework that is relevant when comparing an overhead rate schedule. You know, we talked about generally accepted accounting principles. You know, we know that it's been codified now. We talked about the federal acquisition regulation. You know, we understand that that deals with it's a procurement function. It deals with the allowability of costs. And we've taken a look at the cost accounting standards, knowing that, okay, you know, those standards, the fundamental objective there is the consistency in the measurement of costs. So now let's take a look at the auditing world. Okay. There are three areas. We've got the AICPA standard, generally accepted auditing standards, the AICPA attestation standards, and GAGS, government auditing standards. And we'll look at each one in more depth. Let's look at the generally accepted auditing standards. So, you know, kind of fundamentally as auditors, we have three areas that we have to comply with in our standards. And this is true whether we're under the AICPA standards or whether we're under the Yellow Book, the GAGS standards. And that is there's a concept of general standards, there's a concept of field work standards, and there's a concept of reporting standards. And we'll take a look at each one. The general standards, you know, that deals with stuff like we have to be proficient, okay, and properly trained in the subject matter that we're auditing. Independence, and you're going to hear this as a recurring theme during the presentation today. Independence is just such an important aspect of the auditor's relationship with the work that the auditor does. And we'll see this theme recur. And then finally, do professional care. Fieldwork standards, proper supervision and planning is required. We're required to assess the risk of material misstatement. And, you know, truly, the only way to do that is to get a sufficient enough understanding of the entity, the company that we're auditing, the organization that we're auditing, the division that we're auditing. And we're required to obtain appropriate audit evidence, okay, in order to afford a reasonable basis for our opinion. And we'll look at audit evidence in a few slides. Reporting, the objective of the audit is to issue an opinion, to issue a report. If there are issues, findings, and whatnot, we are required to report those. And the schedule of overhead costs should have appropriate disclosures to make the schedule truly meaningful. I'm not going to spend a lot of time with a test standard, other than just to let everybody know that they're out there. There are three levels. There's an examination level, a review level, and agreed upon procedures level. Okay, so this is just another conceptual framework that's available to us instead of just following GAGS. Okay? In the Yellow Book, in GAGS Chapter 5, there's a great chapter in there that discusses performing an examination level engagement under the attest standards. Great bridge back to the AICPA standards. So if you're performing an examination in accordance with GAGS, then Chapter 5 would be the relevant source of technical information and guidance. There are 13 attest standards, but again, we're not going to go through each one today. You know, some references to the other, to the agreed upon procedures and compliance. Let's talk about GAGS now, the Yellow Book. Much like the AICPA standards, you know, you've got this whole notion of independence, professional judgment, competence. Now, quality control and assurance is different. That requirement, just to clarify, that you don't see in the AICPA standards specifically. You see that in GAGS. So what that refers to is quality control and assurance, not with respect to the auditee or the company that you're auditing, okay? No, that refers to quality control standards with respect to the auditing agency, the CPA firm, the governmental auditing agency. DCAA is a good example. And basically what the requirement is for the auditing agency to have a system of quality controls and assurance, including a peer review. An unqualified peer review is obviously the objective. Okay? So that's different. In GAGIS, for financial statement audits, which is what the audit of the overhead schedule would fall into, GAGIS mirrors the AICPA standards. However, GAGIS goes one step further. It's more stringent. Performing an audit in accordance with GAGIS is more stringent than performing an audit in accordance with the AICPA standards. And we'll take a look at some of the differences. Now, a minute ago I asked if you've ever had any non-audit involvement with your auditee or your client. And doing that is okay, as long as you build in some safeguards. Now, I'm not going to go into a lot of detail regarding the revision of the Yellow Book because there is a whole session tomorrow on that, so I definitely do not want to steal that speaker's thunder, and if you're out in the room, I promise I won't. But I thought it was important enough to at least merit a quick slide here that, when we help our client, when we help our auditee, like I said, that's okay, as long as you built in a sufficient amount of safeguards to protect your independence as an auditor. Also, as you're auditing these overhead rate schedules, if you have a significant amount or number of bar-related audit adjustments, that could call into question your independence, because at what point are you starting to prepare, right, the schedule? If you have enough audit adjustments, at some point you kind of tip over and you get second guess. The link there is an internet link to a wonderful tool that the AICPA has put out to practice to help us as auditors, to help us with respect to building in those safeguards. Okay, so I just wanted to mention that. So now we've kind of quickly gone through the conceptual framework related to auditing an overhead rate schedule. We know we've got AICPA standards that we can follow, and accepted auditing standards. We know that we can perform an examination in accordance with the attestation standards. And then we've talked a lot about GAGIS, and the fact that GAGIS is more stringent. The fact that, if we're performing an audit in accordance with GAGIS as auditors, we kind of sign on to take on additional responsibilities. And we know that is definitely the relevant conceptual framework for us. So now let's look at an actual example, a brief overview of an overhead audit. Now I'm going to assume that this audit is performed in accordance with GAGIS. What I've seen out there, I venture to say that probably 80%, maybe more, of the audits, the bar overhead rate audits are performed in accordance with GAGIS. Right? So with that said, there are three basic components. You have planning and risk assessment. You have further audit procedures which deal with control testing and which deal with substantive auditing procedures, and then finally you have reporting. Now, a quick mention regarding materiality. Materiality, is definitely appropriate, and there's a place for materiality in the auditing world. Now, when doing a GAGIS audit, materiality is more appropriately utilized in the planning, in framing the scope, the planning. However, there's a concept in GAGIS, the public accountability concept, that basically says, look, if you have a disallowance, if you have a finding, regardless of materiality, the objective, frankly, the expectation is to adjust, regardless of materiality. Okay, so I just wanted to mention that, because I think sometimes when we do a GAGIS audit, perhaps we forget that or something. So let's look at the first phase, audit planning and risk assessment. I just want to make a quick note, as auditors, when we sign up to do these audits in accordance with GAGIS, one of the inherent responsibilities that we take on is the responsibility to make our audit file, our working papers, available to governmental officials and or their representatives. And that's right in GAGIS, and I definitely won't read all that, but it's in the Yellow Book. And maybe a good idea for the contractors, the consultants in the room, is in the engagement letter that you have with your audit firm, to go ahead and put that provision in your contract. So I just thought I would make a mention of that. That just clarifies the understanding up front, and it hopefully makes for a smoother, kind of a smoother relationship between your company, state DOTs, auditors, and so forth. GAGAS requires that the audit be properly planned. It requires that we document an understanding of controls, both accounting and compliance, because we'll see later on that one of the reports that we're required to issue is a combined report on internal controls for financial reporting and compliance. And then GAGAS requires a proper audit risk assessment be performed. So with that said, here's a polling question. What is audit risk? Okay, good. So I heard the risk that you might not find an error. Anybody else? Risk we might not get paid. Audit risk is the risk that an inappropriate opinion will be rendered when in fact there's a material misstatement. Say the other, say simply, it's a risk that there's a clean opinion when in fact there's a big error. Okay? And audit risk is a function of inherent risk, control risk, and detection risk. Now, before I go on any further with audit risk, there is a concept that I really want to spend a little bit of time on clarifying, and that is audit risk is theoretically assessed at the assertion level. Now, what does all that mumbo jumbo mean? Okay, so if you visualize your overhead rate schedule, you have direct labor, you have utilities, you have professional fees, maybe, you have rent and so forth. So as consultants, as contractors, when you hand over that overhead rate schedule for audit, you're asserting that the items on your schedule have occurred. You're asserting that the costs on your schedule are accurate. And those first two are GAGAS, AICPA assertions. The other three you won't find in GAGAS, but I believe they're very relevant. And that is, you're asserting that the cost is allowable, allocable, right? Sound familiar? Reasonable. So you're making these assertions to us as auditors when you hand over that overhead rate schedule. Our job is to assess that there's a risk, that there could be a material error with regard to one of these five or all five assertions. Okay? So with that said, inherent risk. Inherent risk, I've got the definition up there. It's a risk that there could be an error, assuming no control. But what that really means is the risk that's predicated on the contractor's business, as an example. So, for example, if your company is large and decentralized, then inherently there's a greater risk than, say, a company that is centralized and smaller. The same is applicable at the account level. So, for example, all things being equal, utilities expense probably has a much lower inherent risk than, say, travel or professional fees. So things like that. Okay, so we have to do the inherent risk assessment based on those types of factors. Control risk is a risk that there could be a material misstatement such that the controls will not prevent or detect in a timely manner a material error. And of course, detection risk. Detection risk is a risk that the auditor's procedures will not be sufficient to detect material misstatements, okay, when in fact they are there. I like the illustration on the screen, particularly to the non-auditors, because it really brings together some of these concepts. SAN being errors, mistakes, whether they're clerical or whatnot. And the first line of defense would be the internal control system that's in place at the contractor's company. And the idea there is for the controls to be robust enough to pick up most, if not all, of the errors. Second line of defense is the detection risk. meaning that the auditor's procedures are robust enough to pick up anything else that the controls might have missed. And the idea, obviously, is that whatever might be left would be clearly inconsequential in terms of errors. So with that said, what risk can the auditor directly control? Right, so it would be detection risk. Because we cannot control the parent, because that's just, okay, that's how the cards were dealt, okay? Control risk, we can't affect that, because that's the company. But what we can affect would be the nature, the timing, and the extent of the auditing procedures that we decide to do based upon the inherent risk and the control risk that we've assessed. And ladies and gentlemen, the idea is for audit risk to be appropriately low enough so that as auditors we have a reasonable basis for our opinion. Here's some examples of higher inherent risk areas. You know, things like bonuses, compensation reasonableness, depreciation. Depreciation, particularly with respect to smaller contractors that might have, you know, stuff like Section 179, you know, accelerated non-GAAP depreciation, rent, indirect labor, marketing bid proposals, vehicle costs, which we'll look at later, you know, corporate segment costs, cost pooling, travel, and so forth. In terms of internal controls, the control environment, and let me just take a minute. The control environment is very, very important, because if you think about it for a moment, the transactional level controls, the controls down, you know, with respect to payroll and things like that, all reside within an environment. And that environment has to do with stuff like policies and procedures, corporate governance, going at the top. Those are all very important, and that's the controlled environment. So doing some audit work there is important. You know, obviously payroll and job costing, and I know the AASHTO guide has some suggested minimum auditing procedures to perform in connection with that. Okay. Direct costs, you know, obviously the idea is none in the overhead. Bar allowability screening controls, you know, that's definitely an area that we look for and that we hope the auditee has. Subcontractor monitoring IT spreadsheet. I would say that the majority of overhead rate schedules are prepared on spreadsheets. And I've seen, you know, I'm talking companies that are $500 million companies or more. They use spreadsheets, and that's okay. That's okay as long as there are good controls relative to the spreadsheet, stuff like passwords, stuff like cells that are calculation cells, having controls in place that those are not overridden. If they're overridden, the calculations don't work and they don't flow up correctly. So those are all good controls that as auditors we look for. You know, some additional items, you know, the consistency in allocating costs. We believe that's important in terms of if you charge it direct, it's direct. If you charge it indirect, it's indirect. And of course, having controls to identify and segregate unallowable costs. For control risk to be assessed at low, it's critical for the controls to be suitably designed and in operation. And it's critical for us as auditors to select a sufficient number of sample items to be able to get enough evidence to afford a low internal control risk assessment. So what do you do if control risk is assessed at high, either because, you know, you pulled your sample and the controls didn't function? You know, you definitely don't want to do more, because that's nonsensical. Instead, if you think about the audit model, what you'd want to do there is get your detection risk low, which means, you know, more substantive audit, okay, i.e. sampling the account and, you know, doing things like that. And the next polling question is, auditors, are we required to specifically address fraud? And what are some types of fraud that might be out there that's relevant to an overhead rate schedule? One of the areas that we, you know, usually identify as a potential fraud risk is the notion of having losses on a contract or a job, a project, charged down to the overhead. So that's definitely a real risk that exists. As auditors, we are required to assess and address fraud. That's in both Statement of Auditing Standards number 99 issued by the AICPA, and it's in GAGS. And, one of the things that we're required to do is a so-called internal brainstorming session. Kind of like we started to do now. Gosh, where could fraud occur with respect to this particular auditee? Depending upon the nature of their business and so forth. So that's definitely something that we have to remember, and that should be documented in our working papers. Kind of sort of pooling this all together, doing detailed analytical reviews, and that's where materiality becomes important. Utilizing the results of our internal control group for us to be able to properly assess the risk of material misstatement for each of the relevant assertions, of which we know that, I believe, there are 5. Now, based on this risk assessment, further audit procedures are developed, okay? And they're developed so that the detection risk can get down to a low enough level so that we can have audit risk at an acceptable level to afford a reasonable basis for our opinion. So, I want to spend a little bit of time. This is an example, okay? And let me preface by saying something. I believe that there is a significant expectation gap that might be out there. And what I mean by that is the expectation in terms of the work that CPAs are doing when auditing overhead rate schedules. The expectation that state DOT officials have, particularly whenever you're charged with doing a cognizant audit review. And frankly, the expectation that the auditor to the client has in terms of what they believe their audit firm is doing. Okay, and like I said a minute ago, I think sometimes people kind of lump us all together as auditors, and they believe that we have the exact same perspective and so forth with it, when in reality that's not true. So, maybe a little participation, because I am truly legitimately curious here. So here's the setup. Here's the example. Professional fees. The relevant assertion that we're performing this assessment on is allowability. Okay. Inherent risk is high because of the nature of the contract and the nature of the account. Control risk is high because there are no controls, let's say, at this particular contract. And now detection risk needs to be pretty darn low to get that audit risk, okay, low enough to be able to afford a basis of an opinion that, yes, indeed, there are no material, unallowables in that particular account. So what procedures should the auditor do? And would analytics alone be sufficient? And I'm curious, what do my colleagues think here? Don't all go at once. Yes, ma'am.
Significant, assuming it's material.
Yes.
Significant detailed substantive testing, you can't rely on analytics.
Okay. So significant substantive testing cannot rely on analytics. Do most people concur with that?
Yes.
What would you say then would be significant? So, sample of 5, maybe?
Depends on the number of transactions that are in the account.
Okay, let's say there's a lot. Materials,
Some type of stratified sampling statistical test, and you can extrapolate to the rest of the population based on your errors.
Okay, so you're saying stratify the population, maybe pick out the big dollar items, things like that, and then sample the rest of the
Some
sample.
type of statistical sample so that, if you've got a 60% error rate in, 100 samples that you took out of a 400 population, then it's probably representative of the entire population, and you may have 60 to 70% throughout the rest of the 300 you didn't test.
Okay, so you're saying, you really have to have a sample size that's large enough, statistically speaking, to give you the confidence that you need in order to have a reasonable basis for a conclusion. Yes, I mean, no, very good. Any other thoughts? Does anybody, would anybody, I don't want to say disagree, but they maybe have a different mindset or viewpoint?
I mean, if you put a good predictive analytical, I would say you could rely on that. If you have good factors that are winning, you do a good predictive analytical, the only application, you have to back up with substantive procedures.
Okay, so then the gentleman said, well, look, you can do predictive analytic, and if the predictive analytic matches what you believed should be occurring, then perhaps maybe you're, if I'm understanding, then perhaps maybe that's appropriate, that's sufficient, if you will. Yes, sir.
This might be one of those examples where you get into managing expectations between the safety lead and the auditor.
Perfect.
And agree ahead of time on what your procedures will be.
Okay, so the comment was, well, maybe this is a case whereby you agree ahead of time, the auditor, I'll assume it's an auditor with a CPA firm and the state DOT official would go ahead and agree in terms of what would be an appropriate course of action. Okay, well that's definitely, and that's a great practical tip. The challenge sometimes though is if you're doing stuff real time, then it's kind of hard to coordinate that. But that's a great practical tip because managing expectations, I think, is definitely a challenge that's out there. And you have 3 auditors, you get 4 opinions, I think. How about this example here? So this is a different contractor, kind of the same set of circumstances. But in this case, the auditor went ahead and tested controls, found that the controls were working properly in terms of allowability screening, okay? So now, did a sufficient sample size to afford that evaluation of low control risk and high inherent risk. Now what do you think? Because their detection risk maybe could be moderate. So what's the expectation here? What would you do if you're the auditor here?
If it's a high-risk account in general, professional fees are typically high risk, then you have to go with the large dollar and then test of 2 to 20 acres, and assuming you're going to follow the audit guide.
Well, let's thank you. So the reply is if it's a high-risk account, then you have to be cautious in terms of following the suggested procedures in the audit guide. The question then would be, well, is this truly a high-risk account? I wonder, because we've got, inherent risk is high, control risk is low, so detection risk could be maybe moderate. You don't want it high, probably, because then I think that would tip your auditors to being at an unacceptably high level. But see, this is where it gets a little gray. This is where the art of auditing comes into play. Because maybe we should ask this question in your minds. Would you say that this is a high-risk account? In your minds, do you think this is a high-risk account? I heard a no. I heard a yes. There you go, folks.
Well, if you compare their professional fees to what they had last year,
Okay.
to what they have this year, and it's a high increase,
Okay.
and you have a lot of legal fees going through there, and if you get a letter from the attorney saying, this is what we worked
Right.
on, you might be testing, whether or not what they worked on in the majority is allowable for that account. And maybe you have organizational expenses or reorganization, or may have set up something, or may have a lawsuit,
Right.
that is not allowable.
You bet those are all the risks.
Right.
Having unallables, whether it's a lawsuit that's unallowable, maybe settlement costs, things of that nature. But where it becomes a little bit more, shall we say, complicated or gray is in this scenario, you would have tested controls, and you would have found the controls to be functioning correctly, meaning that the contractor would have gone ahead, identified, sequestered those costs, and removed them from the overhead. And as auditors, we're saying, hey, we tested those controls. They functioned and got to the low control risk. But, we know that that's normally not good enough, okay? We know we still have to do something to get detection risk, because if you do nothing, if you're done, then detection risk is theoretically high. So now you've got 2 highs and low. So audit risk is now potentially too high. So the question becomes, well, what is appropriate? What's just enough? I hear, well, gosh, maybe sampling, maybe nothing, maybe analytics. Maybe, and then one person said, well, this account is low risk, the other person said, well, no, the account is still high risk. And I think the challenge here, ladies and gentlemen, is that there are no clear-cut answers necessarily. We have our conceptual framework in terms of the auditing standards, GAGAS. We know we have to, at a minimum, perform these risk assessments and document these risk assessments. And we know that, well, yeah, we have to make sure that audit risk is at an appropriately low enough level to afford a reasonable basis for your conclusion that there are no significant or unallowable costs for this particular assertion. And we're supposed to do this analysis, by the way, for every assertion: accuracy, occurrence, eligibility, reasonableness. So I think that the point here is that there's definitely some differences here in terms of the thinking. SAS 110, which is the Statement of Auditing Standards number 110, it sheds some light in terms of the risk assessment. And in general, what SAS 110 says is that if there are no controls, or if your control risk is high, then you definitely have to do some work. And you've got to do some substantive auditing work to get. Yes.
No, and in that case, we've had that instance, and we had them call Office Max and get a copy of the receipt.
Okay. Excellent. So the question would be, well, gosh, what could you do to make it, right? To make it appropriate, to make it sufficient. And your case was, well, hey, you call Office Max and you get the receipt. Okay. Excellent. Okay. How about the second one? I love this one. My favorite. This was a handwritten receipt, okay, for a catered dinner. And I think there was 24 people that attended. Each dinner was about $295. I will say the handwriting, the handwriting. Wow, don't see that very often anymore. And it footed and added correctly and extended and all that. And that's all they gave us. So what do you think about that? Is that sufficient?
No.
Is that appropriate? What could this contractor have done to make it sufficient, to make it more appropriate?
Include the
Minutes? Excellent. Any other thoughts? What?
invoice from the hotel.
Invoice from the hotel, yeah, thank you. Right. They could never find that. Yes, sir.
This allowed the unreasonable amount for the submission?
Yeah, right. That's a whole other topic, right? Right. It's a whole other topic. Number 3. This was a situation whereby the contractor had multiple offices. Okay, and they had an employee from their Los Angeles office fly to their San Francisco office to attend a strategic planning meeting. So the employee stayed, 2 nights, 3 days. And we selected that for audit. And they gave us this employee's, they gave us his expense report. And that's all we ever got. That was the expense report. What do you think about that? Would you? Okay, I hear receipt. So what could they have done to make it allowable or appropriate, I should say? Receipts would have been nice. Never got receipts. Just got the expense report. They could not understand. Why are we hassling them? It's not that we're hassling them. We've got a set of standards that we have to comply with here, folks.
What did they use to pay him? Reimbursement?
Yeah, it was. I think it was just an electronic funds transfer when they do the. So because he had other expenses and whatnot, so it was just one EFT into his.
What's their policy on reimbursing employees? Do they not require receipts if they're on the audit?
Pretty much. Well, they had a policy that was very sketchy, I guess. And we'll look at this later in terms of the importance of good controls. And one of the goals of going through these actual examples is just to hopefully for the contractors in the room, the CFOs and controllers and so forth, to maybe, help us in terms of, let's work as a team so that, there's enough documentation, just awareness, I think. Finally, number 4, we were given, this was a dinner that the contractor had with a prospective client, and we were given just the Visa card statement. It had the restaurant, the date, and that was it though. The charge was coded. It was charged to the proposal account and the overhead. And that's all we ever got. So what do you think about that? I think that's sufficient and appropriate?
No, it's whining and dining, it comes out anyways.
Whining and dining comes out anyway, someone said. I have a lot of contractors that would disagree with that. But in terms of just audit evidence, though, do you think that's enough? Let's say that, let's assume that yes, it's allowable and all that, but is that enough? I wonder. Is that enough? Is that appropriate audit evidence? For audit evidence to be appropriate, it needs to be relevant and reliable. And travel costs. Travel costs are definitely an area that, shall we say, very challenging. Okay? And 31205, 46 has some minimum criteria. Now, what I have at the bottom in bold is directly from the DCAA audit manual. It's non-authoritative, but I thought it would be interesting. And I'm just going to read it very quickly. It says, this information, meaning, items 1 through 3, must be maintained in a book, diary, account book, or similar records. Documentation such as canceled checks, credit card receipts, and hotel bills are to be maintained as corroboration for expenses, but without the diary, which someone mentioned, or similar records, they may not be sufficient support for deductibility. So, kind of an interesting perspective in terms of what the folks at the DCAA think, okay, regarding audit evidence as it pertains to travel. Now let's look at the third and final phase, and that's reporting. So once we've done our risk assessments, we've done our planning, we've performed a sufficient amount of auditing procedures, we have gathered appropriate audit evidence that's perfect. Now we're ready for the reporting. So the goal is to issue an opinion on the schedule of overhead costs and to issue a combined report on internal controls of financial reporting and compliance with contracts, laws, regulations, and partnerships. Now, as auditors, we are required to report any significant deficiencies, material weaknesses, fraud, abuse, and so forth. If we do have any findings, it's always a good idea to also include management's response in our reports. And let's talk a little bit about the different categories of internal control deficiencies, because there are 3 categories. This is in Statement on Auditing Standards number 115, SAS 115, and it's also in GAGAS, Chapter 4, 4.23. Control deficiency, significant deficiency, and material weakness. So the definition of a control deficiency, it's very simple. It's a deficiency in the design or operation of a control that does not allow employees, management, in the normal course of just performing their day-to-day to detect, prevent, and timely correct material mistakes, material errors. Now remember, for a control to be effective, it has to be properly designed, meaning it has to be robust enough, and it has to be in operation, meaning you have to do it. Many times I see very well-designed controls, but no one follows them. They're not in operation. And you need both elements. Policies and procedures alone don't cut it. You have to do it. A material weakness. A material weakness is a deficiency or a combination of deficiencies in controls, such that there's a reasonable possibility that there might be a material error, a material misstatement that in the overhead schedule, in this case, that will not be detected, prevented, or corrected. A significant deficiency is a deficiency or combination of deficiencies less severe than a material weakness, but important enough to merit the attention of those charged with governance. So the board, the ownership, the head of the department, if you're a governmental auditing agency, and so forth. Okay? Now, the technical literature does give us some guidance in terms of the categorization of a finding, whether you just have a control deficiency, or whether you have a significant deficiency, or whether you have a material weakness. Now, ladies and gentlemen, there is most definitely an area of judgment here. No question, and occasionally I will arm wrestle with the consultants about, well, it's not a material, it's really no big deal. So there's definitely an area of gray here. But our professional standards do give us some tools to help with categorization, because that's important. Okay, we've got a little bit of time left, so I want to take just a really quick, a slight detour. And this detour, I thought, would be relevant because it just simply exemplifies the importance of having good systems, good controls, okay, from the perspective of the government, the federal government. So here goes. We'll start off with a polling question. Does the FAR have a definition of an accounting system? Yes or no? What do you think? Yes, maybe. The answer is as indirect and other direct costs, compensation, billing, labor, and general information technology. Sounds familiar. The fundamental objective, according to the FAR supplement, is assurance for the system to give assurance that applicable laws and regulations are complied with. The accounting system and cost data are reliable. The risk of misallocations and mischarges are minimized, and that contract allocations and charges are consistent with billing procedures. Now that's interesting, because sometimes billing procedures I've seen, in my experience, are not always consistent with the accounting and the general ledger. Okay? Just saying. There are 18 criteria, and I'm not going to go through each criteria. I won't bore you too much here, but I highlighted a few that I thought were, shall we say, interesting. The first, a sound internal control environment. So there, the federal government believes that a controlled environment is important. So it's the accounting framework and the organizational structure. Proper segregation of direct costs from indirect costs. That sounds familiar. How about number 12? Exclusion from costs charged to government contracts and amounts, which are not allowable in terms of federal acquisition regulations, Part 31. No surprise there, really. Number 15 I thought was interesting. Cost accounting information as required. To readily calculate indirect cost rates from the books of accounts. So, meaning if you're using a lot of spreadsheets, and then spreadsheets are not evil, they're okay, they're fine, don't have controls. But if you're using spreadsheets, you have to be careful with the significant amount of manipulation, because if that happens, then really the idea there is to have an appropriate trail so that your overhead rate schedule can be reconciled back to the general ledger. And interestingly enough, that's one of the 18 criteria here that's the FAR supplement. Okay? And then finally, number 18 I thought was noteworthy, accounting practices in accordance with the CAS, Cost Accounting Standards Board, if applicable, okay? Otherwise, generally accepted accounting principles. And ladies and gentlemen, folks, tax rules do not apply. But invariably, every year, I'll get two or three consultants, nobody in this room, that will try to assert hey, it's deductible, it's in the code. I'm like, that's great, it's not allowed. So, some questions to ponder. Does your company properly address all 18 items? Some takeaways. It's important to have strong controls. I think that's the fundamental message here. And as auditors, it's important for us to really step up to the plate here, document controls, and let's start auditing the key controls. Some FAR contracting implications for the contractors in the room. Well, accounting, financial reporting is one of the 6 business systems. It's the first one, it's accounting. And under a new rule that was issued in February of this year for CAS-covered contractors, and this was DOD, if one of your 6 systems is found to have a significant deficiency, then you might be subject to payment withholds. Okay? So the final rule defines a significant deficiency, and I'm going to read it quickly here. It's a shortcoming in the system that materially affects the ability of the officials of the DoD, Department of Defense, to rely upon information produced by the system that is needed for management purposes. Okay, so that's their definition of a significant deficiency with respect to a business system. Okay, now, that's a systems-wide definition, not an individual control definition. So that can be, it can get a little confusing maybe. So it's an entire systems issue. A significant deficiency under SAS number 115 is different from a significant deficiency per this final rule, or supplement. SAS 115 is at the control level, okay, in terms of a significant deficiency, while the DoD final rule is a systems-wide. But the question, and this is the question to ponder, and that is, at what point do material weaknesses under SAS 115 again? At what point do significant deficiencies under SAS 115 again is tip the business system over, tip it over, so that there's a risk that there could have a significant deficiency system-wide. And there's no guidance on it. And hopefully there'll be some guidance forthcoming. We'll just have to stay tuned. Some takeaways here. It's certainly in my mind, this has really ratcheted up the importance of internal controls for contractors, for consultants out there. And for auditors, I think now more than ever, it's critical for us to identify and report significant deficiencies, material weaknesses, but you can't do that unless you audit controls, or unless you obtain a rudimentary, or even really more than rudimentary, understanding of the control environment and the transactional controls of your auditee. With that said, let's take a quick look at some common issues and findings. Fundamentally, ladies and gentlemen, I would say that most of the findings that we detect and we stumble across, if you will, have their genesis in insufficient internal controls. Not identifying properly accounting for allowable costs has to be at the top of the list. Inadequate job costing systems, we still see that. Inadequate systems for tracking allowable versus unallowable marketing. Marketing seems to be an area that's challenging. Vehicle costs. Vehicle costs is another area in terms of not having a sufficient amount of controls, whether it be preparing mileage logs, whether it be tracking costs. Internally generated costs. Occasionally we still see the offset method, so the cost pooling method being used, okay? Using standard costs is fine. Just remember, if you have a significant variance, you have to dispose of it correctly. You can't just let it finger in the overhead. And I have battles about that one sometimes. Some other areas, lack of receipt documentation, particularly with regard to travel, office meetings, and recruiting. Those seems to be themes that reoccur in terms of issues, okay? Some common disallowances, vehicle costs. Vehicle costs seem to be a challenge in terms of having compliant methodologies for allocating vehicle costs, whether it's mileage logs or whether it's some other methodology, as long as it's compliant. And compliant, with respect to the conceptual framework that's out there, FAR, CAS, and so forth. Public relations and advertising costs. Entertainment, excess compensation. Boy, I shuddered. I almost didn't even put that up there because I didn't want to be, I don't know, you guys throw darts at me or something. And I know, you've got the national compensation matrix, and I know there's all sorts of discussion over, well, gosh, what is that? What's reasonable? What's excess? And I know there was a court case that just came out that, is tweaking this issue even further. So anyway, so that's definitely an area. Direct costs and overhead, we still see that, in terms of the inconsistency there. Okay? Reasonableness. Travel costs over investment and bonuses, and this whole notion of the distribution of profit. Okay? Acquisition costs, insufficient documentation for travel, legal costs, particularly significant settlement costs that are being charged that are not allowed. Compensation incidental to business acquisitions, not so much anymore, but back a few years ago when there was more acquisitions going on in the A&E world, we saw bonuses being paid, retention bonuses, things like that. That stuff's just not allowed. Amortization of intangibles, that happens again in connection with acquisitions many times. Idle facility, and related party rental costs, but really related party costs, you have to be very careful there. Okay? Well, kind of by way of a wrap-up, as contractors, the requirement, the idea is to follow the relevant conceptual framework when preparing your overhead rate schedules. As auditors, we are required to follow the relevant conceptual framework in performing our audits, knowing that the majority of these overhead rate audits are performed in accordance with GAGS, government auditing standards. Appendix A of the AASHTO Audit Guide is a wonderful tool for us as auditors to utilize for the purpose of satisfying ourselves that indeed we've met the requirements. And hopefully we've met the expectations of the DOT auditors. And frankly, it's important for all stakeholders, whether you're a program officer, state DOT, you're the CFO, contractor, or whether you're auditing for a CPA firm. It's important for all of us to have a good understanding of the framework that's out there. Education, training, it's so important. You just can't get enough in my mind. And finally, ladies and gentlemen, as auditors, we're required to be independent. Okay, so in final analysis, we just want it right. So, with that said, who has the first question? You guys must be very hungry then. Anybody have any questions? Yes, sir. So the question is, one of the general standards in both AICPA standards and GAGS is auditors are to be sufficiently trained and proficient. Well, so what does that really mean? Thank you for the question. Well, there is no clear-cut answer. However, kind of in our minds, what that means is that the lead auditor should have some on-point experience with respect to the subject matter being audited. When doing a GAGS audit, we are required to have minimum continuing professional educational items. So we have to minimum have that. GAGS does not have any minimum number of years doing an overhead audit, as an example. It doesn't have that. But rather, what it has is the requirement that the auditor has a sufficient amount of technical expertise to be able to correctly assess audit risk, to correctly understand, well, what are some relevant further auditing procedures, I mean, those two, audit risk is very important. And enough experience to understand, well, what do I need to know relative to controls? What do I need to know relative to this industry? Inherent risk is a great example of that. It's very difficult to adequately assess inherent risk if you really don't know anything about the KA industry. I just think that is so difficult. It's difficult to do these audits if you know very little about the farm, very little about the cost accounting standards. And frankly, I think the more education, the more we know, I think that's how we can minimize the expectation gap, which we saw even today in the two examples regarding professional fees. There's definitely an expectation gap relative to what's enough work and relative to what each of the different constituencies believe is appropriate for auditors to be doing, whether you're the contractor that has to pay for the audit, whether you're the DOT that has to rely on the audit, whether you're the auditor that you have to do the work. Thank you for your question. Who has the next question? Yes, ma'am.
Some of the slides that I was asking, available somewhere?
Oh, yes, the slides. The slides are definitely available.
They will be available on the website, maybe available right now.
They are.
They're definitely available, and we will keep the website up for 30 to 60 days after the time. Every set of slides we can provide, we will. Some are proprietary, we're not allowed to have.
We definitely have mine. And then you know what else I'll do, folks, is I'll go ahead and on the ADOB website, I'll post that practice aid, the one that will help us as auditors to build in safeguards when doing non-audit involvement work or services, so that we can have that in case you want to refer to it. Yes, sir.
I have a question on the disclosures in the thing. We made that farm is really working with the actual guidelines require minimum disclosures. So if you have a consultant who's saying, well, tell me what's authoritative here, tell me what I need to be disclosing, what's your answer to that? And let's say there's a required minimum disclosure for this thing, I don't want to put that in there, and your audit opinion doesn't reference the actual guide.
So the question is, if you have a situation whereby the contractor is maybe wondering or challenging a disclosure, and the disclosure is a disclosure that's required or recommended by the National Audit Guide. So the question is, what to do in that case whereby the contractor would, I'm going to assume, would prefer not to have the disclosure, or believes the disclosure is not relevant, let's say. Well, thank you for the question. That's a very difficult one because, the auditing standards, disclosures are really an auditing standard item. It's the reporting part of GAGIS, right? Because we've got general standards, fieldwork standards, and reporting standards. So as auditors, we have to comply with the reporting standards of GAGIS. So, GAGIS requires that the disclosures be informative. GAGIS requires that the disclosures complete the numbers, if you will. With that said, you have to default now to practice aids. I know there's, some organizations have financial statement disclosure checklists, things of that nature. But truly, at the end of the day here, there is an element of judgment in terms of, informative disclosures. With all that said, I would recommend that you follow the National Audit Guide because it's a great practice aid. And as an auditor, I would prefer to do that than, frankly, than to be second guessed in terms of not having enough disclosure. And frankly, disclosures is a challenge in the farm overhead world, and it's a challenge in the financial statement world as well, in terms of adequate disclosures, not disclosing the transaction that you otherwise should have disclosed. There's been scandals. It's impossible for literature to be able to address every single circumstance, but I think in this particular case, if there's a disclosure in the actual audit guide, then we as a firm definitely, we put them in. Because we believe that to have a true understanding of the numbers, you need that disclosure. Someone else asked, well, what's enough training? Proficiency of an auditor. Well, I think part of the answer to your question is having an auditor that understands some of the nuances related to your industry, some of the nuances related to the challenges of who's using that far overhead rate schedule. And to the extent that you're going to use it to negotiate, okay, then sometimes, more is actually better. Because if it's not there, then you run the risk of having your governmental agency ask questions. And that's where the efficiencies come into bear. So the long-winded answer to say, use and follow the actual audit guide disclosure requirements, because that, really is, when we do that, then we're becoming pretty satisfied that we have complied with our professional auditing standards in the area of reporting. Okay.
Follow-up question on that. Whenever I get guidance from a DOT perspective, I suggest that, if in doubt, provide for this disclosure, because that provides a lot more information for the states. Is there much of a risk on the part of the CPA or the owner of the financials, in the statement of the A&E company in this case, to have extended disclosures?
So the question is there any kind of a risk factor out there for having extended disclosures? Either risk factor either with respect to the CPA or a risk factor with respect to the management, the ownership of the A&E firm, let's say. Well, from the auditor's perspective, from the CPA's perspective, to the extent that there is more disclosure, then we just have to make sure that disclosure is accurate and complete and so forth. So from that regard, yes, there is an element of potentially additional work that we might have to do to get comfortable that disclosure is properly presented, properly stated. On the part of the A&E firm, I'm speculating a little bit here. So for the management of A&E firms that are out there, if I'm way off base, please let me know. But I think the reluctance might be, this whole notion of competitive advantage versus a competitive disadvantage. Potentially that might be one of the factors that might, cause some reluctance on the part of an A&E firm to disclose a little bit less, because they're just not sure, who's going to look at that audit, who's going to look at that schedule, and if a competitor looks at that schedule, am I somehow putting my company at a competitive disadvantage? I've heard that. But I don't know if anyone else has any insight or perspective in terms of more disclosure potentially being problematic. But that's a great, thank you for the question, because yes, we do wrestle with that sometimes, and I have heard this whole notion of competitive advantage, competitive disadvantage, and so forth. But again, I think that it's prudent for all of us to work together, and as CPAs, I can't see us going wrong, if you will, if we are facilitating the process to make it more efficient. It cuts down on the time that the DOT audit agency has to expend, and frankly, it cuts down on the time that the consultant has to expend in terms of doing additional analyses and things of that nature. And very selfishly, as a CPA, it cuts down on the potential that I might have to somehow get involved in providing more information and get involved in those discussions. And I don't mind doing that, but boy, if there's a disclosure here and there that might help, then that's the way to go with it. Any other questions? Yes, ma'am.
A comment on the disclosure question you had. It's really a matter of the overhead schedule should be able to stand on its own. It shouldn't require additional questions about how you came up with this, that, and the other. And so those disclosures allow for the questions to have been answered without additional discussion. So, all of the disclosures listed in the audit guide provide that information, and that's the whole purpose. And then you don't have to get into conversations where information is relayed to various agencies that might be taken differently or misconstrued. It's in black and white.
Sure, that's right. So the point I believe that you're making is if you prepare your overhead rate schedule and you, at a minimum, have all the disclosure requirements that's in the actual audit guide, then that's, to a certain degree, I'll use the term, maybe it's kind of a safe haven of sorts. Okay, and I think, yeah, there's definitely some element of that. But I think the challenge sometimes, though, is that there might be some reluctance occasionally on the part of the contractor to even have the disclosure requirements occasionally, and I think that was, one of the questions earlier. But again, I think the idea is to the extent that we can all work together, and to the extent that we can provide disclosure that's appropriate, that's relevant, that's helpful, then we should do that. It kind of levels the playing field too, which is what I like about the minimum disclosure. Because if everyone's doing it, then this whole business about competitive disadvantage kind of goes out the window a little bit. So, any other questions? You have been a fantastic audience. Thank you very, very much. I really appreciate your participation.
Tony, thank you very much. As a small token of our appreciation, again, this is not meant to persuade you to do anything or not do anything.
You're going to determine independence.
Just sending a book of Arizona Hayes photographs to help you appreciate our research today, which I know you already did. Tony, thank you very much. Just one quick announcement before we head to lunch. Lunch will be in the, I think it's referred to as Column A, B, and C. It's the same rooms where we had our reception.